criteria. It's quantitative and it's stated. They tell you what it is. Qualitative are a little bit different in that they're a bit more descriptive. The first set, which we will call objective, is the idea that in the house example, it either has a pool or it doesn't. It's not a numeric quantitative, it's almost binary. In the investment world, as we list here, it's underperformed the index. So the stock's underperformed for 2 years. For a manager, that might be an important criteria because they want to buy something that's, quote, out of favor. They want to look at that kind of a. So another portfolio manager must say, I only want things that outperform the market because maybe I have a bit more of a growthy momentum sort of style to it. That is a qualitative and stated number. You then move to this stuff that gets a little bit squishier, which is the notion of subjective criteria. And the ones we listed, I think, are very important. I only look at companies with a strong competitive position. Sounds good. You write it down and say, yeah, that makes sense. I can see why you'd be attracted to that. You start doing your work and it's like, well, wait, what did they mean by strong competitive position? I will define it differently than Paul. We have a different sense of that. I'm very passionate about my sense, and he's very passionate about his. Each portfolio manager is going to have their own interpretation. Next one, I like good capital allocation. I only like management teams that are good at capital allocation. Historically or going forward, presumably going forward. What does that mean? That they'll only invest in their industry where they have a franchise and high returns, or they're thoughtful about M&A, right? It starts to become very difficult to determine upfront what that criteria is. And then the final one is management owns stock, so management has some skin in the game. Well, what if management owns 80% of the company? No, they own too much. So you start to see that these statements, although they're declarative statements, they're very hard to identify. And I'm hoping you're starting to get a sense that this is getting complicated fairly quickly. All of this was stated. The portfolio manager told you and said you work for him. He said, look, we're looking for all this criteria. This you can sort of map pretty well. This starts to get a little bit different, and this one is all of a sudden it's a matter of interpretation. We're not going to talk about it today. We do talk about it in the book. One more layer, which is there's also another set of unstated criteria that either they forgot to tell you, or maybe they're not even aware that they know. So the problem, of course, is in an interview, you might know very little of this. If you're going for an informational interview, maybe you haven't even thought about looking at what they look at. If you're in the job, if you can't do this well over time, you'll lose your job. And that's sort of the challenge you're going to have. What I want to pound away as is every portfolio manager has an investment criteria, maps to this. Your job is to present ideas that they're interested in. Let's go to the next slide. We talked up front, remember there are the 3 criteria. This was Dr. No. We put that in place because portfolio managers are inundated with information and ideas. They have to manage their time well, information overflow. So it's no is the default answer for almost every recommendation. You've got to get past that. However, the PM will only listen, the PM will listen if you can satisfy their stated criteria, that objective criteria. But as we move on to the right of that criteria, where it gets a little bit fuzzier, if you don't hit that subjective criteria, they're not going to adopt the idea. And what Paul and I discovered fairly early in this process is this is pretty well understood, and this is, we'll argue, was no one, we had never read anything where they had pulled this out. And I know when I go talk to my friends that are analysts, they'll tell you it's very frustrating. They'll hit this criteria all the time, and the portfolio manager will say no. And when we present to them and say, well, there's another set of criteria that's either subjective or perhaps not even stated, the light bulb goes off. They get that. When I go talk to portfolio managers, they say analysts are very frustrated, and they'll pitch ideas, and they're not even close. When we tell them, we say, how do they do here? And they'll say, oh, they're pretty good here. But they never seem to figure this out. So the moment we started to put this out there among professionals, it was like, this makes sense. So your challenge as a young analyst, whether you're pitching for an investment contest, pitching an interview, or ultimately in your job, is you've got to start to understand who the audience is, both their stated objective criteria as well as this subjective criteria. All right, that's your security. That's what you're going to pick. You pick something your audience wants. The next one is content, which is, we'll go to the next slide. Every portfolio manager wants you to answer 4 questions. So the first one was the stock, right? The second one is, you got to answer these 4 questions in your recommendation. And we think every portfolio manager wants you to answer these questions. And if you don't answer these questions, they're not going to buy your recommendation. First question is, how much can I make? Sort of makes sense, right? What's the upside? Second question, how much can I lose? Again, makes sense. That's sort of the risk side of it. If you come in and say you can make 100%, but you could lose 100%, some portfolio managers will find that interesting. Some portfolio managers say, too much risk. If you came in and say you can make 100% and not lose anything, I think most portfolio managers would be interested. The third and fourth question get very little attention. However, I'm pretty convinced that that is where a lot of recommendations just die, which is the next one is, how'd you figure this out? This is too good to be true. You come in their office and say, guess what, this is mispriced. We think I'm going to make a lot of money. Portfolio manager gets excited, you've explained the upside, you've given them some sense that the risk is manageable, and then they just wake up and they're like, wait, hold on a second. How did you find this? Why are we getting this idea? How did this land on my doorstep? As Paul says, which I love, oh Lord, why me?
Why me, oh Lord?
Oh, why me? I'm like,
And it's Judd. It's not.
As Judd. It's just sort of, he, one of his partners when he ran his fund, a friend of ours would say, why me, oh Lord? How did we get this? And every portfolio manager, we think, once they get through the first two steps, stops that. And then the fourth one is really important, which is, it's mispriced. You've convinced me it's mispriced. But if the rest of the world doesn't figure this out over time, it doesn't matter. Because I only get my return when the rest of the world realizes that it's mispriced. I buy it, I want them mispriced. So those are the four questions. We're going to run through this, give you a couple examples, and then we'll come right back to where we, at the end, we'll come back here. All right, so first is, how much can I make? I will argue that in most situations, the most important value drivers are the fundamental cash flow, aspects of the cash flow of the asset. There are other special situations, of course. Sometimes the balance sheet really is the source of value. But for most operating companies, it's the cash flow they generate. And the cash flow only has four components. So if you're going to argue that you have upside, the stock is mispriced, and you've priced it better, at the end of the day, you're going to have to track that back to some fundamental value. You're going to have to be able to show the portfolio manager, hey, I think there's upside because my estimates of these fundamental value drivers is different than the market. So I mean, we refer to it as a varying perspective. We'll touch on that again a bit more through the rest of the slides. But you come in and argue that the market is effectively wrong. You have a different sense of value. Go to the next one. That's question one. Question two is, how much can I lose? We have a chapter on risk. It's a lot of charts. We'll run you through just a quick sampling of that, which is the first one. This is the consensus estimate of what the stock is, 85. This is where the stock is trading, 80. There is, in theory, potential upside as it goes from 80 to 85. That's a target. If, in fact, we find out that the real value is less than 80, you're exposed to risk. You're going to lose money in the investment. So as you talk to the portfolio manager and say, market thinks it's worth 85, stock's trading at 80. By the way, any scenario where it's less than 80, we're going to lose money. So you start to talk about it. Next slide. Where you get the portfolio manager really excited is if you come back and say, the market thinks it's worth 80, I think it's worth 90. That was that first question, right? I think it's worth 90. But not only that, we've done enough work that my sense of confidence around my estimate is fairly tight. Whereas before we had this kind of distribution of potential outcomes, you've presented a case where you think it's worth more than the street, and you've done enough work that you can bound that set of expectations. So you have greater accuracy and precision in your estimate. Your estimate's higher than the market and better. As a result, now you can see that, guess what? The outcomes less than 80 are significantly less than what the street thinks. And your estimate of risk all of a sudden is very low. And this is a much more appealing case to the portfolio manager than the original one. And what have you done? You have a more accurate estimate and, oh, by the way, I'm sorry, you have a higher estimate and you have a more accurate estimate. Okay, next slide. Third question is too good to be true. There's only two ways for the market to be wrong. Either they're wrong in their estimate of intrinsic value, at least that's how we're talking about it today, or they're wrong in how long it will take for the market to realize it. That's it. So the first question was, I have a higher estimate because of the fundamental drivers. Second question was, I have a lot of confidence, I've done a ton of work, my range is tighter. Third question is, why did we find this? We did the work, and we've been able to identify that the market's either wrong in its estimate of intrinsic value or its estimate on how long it will take for price to realize that value, which obviously is a form of catalyst. It's what your argument is, how the next guy will figure it out and at what pace. That's it. That's all you got. All right. If your consensus estimate is this, I'm sorry, if your estimate is the same as the consensus, you're not arguing it's mispriced. So there is nothing to figure out. Market's not wrong. So if you come back and you say, I've done all this work, I think it's worth 85, and the stock and the market thinks it's worth 85, you have not identified something that's mispriced. And therefore, guess what? Your consensus is, your estimate's the same as the consensus. There is no opportunity. And that's why it's very important as the third question. You have to be able to articulate why the market's wrong. When Paul and I have sat through a bunch of pitching contests in the last year or so, and at the end of it, we see is that people have done an excellent job of describing the opportunity. Excellent. They know the company really well. They've done an enormous amount of work. And we always look at each other and say, I'm not convinced it's a mispriced. They've done an excellent job of convincing they know the company well, and it's a really great company. But they've done no work on convincing me that there's a mispricing. So unless you can articulate what the market is missing, I all of a sudden lose a lot of interest. You can see how the portfolio manager just closes their book, puts their pen down, and moves on. All right, final question you have to talk about, which obviously leads from this, is how's the next person going to figure it out? So you have a variant perspective. You argue all of this. Market's wrong. That final piece is, what is the event, or what's going to cause the rest of the world to realize that that is mispriced and want to buy the stock? Might as well go to the next slide. We've identified that as a catalyst. In the book, we generally talk, almost specifically talk about hard catalysts, which tend to be an event. Something comes along, an announcement or some sort of competitive position, or new information enters the market, and that's viewed as a catalyst. All of a sudden, the stock price reacts to that information. You get a lot of performance in a short amount of time. Another catalyst can be just time. I tend to refer to as a soft catalyst. Just over time, the company continues to perform well. Investors realize it's a better company than they thought it was. Stock naturally outperforms. So those are really the four questions. How much can I make? How much can I lose? What's the market missing? And how's the next person going to figure it out?
Why didn't we put that slide in the book? Like,
I don't know.
Is it free?
Paul and I, we finished writing the book at the end of July, which wasn't that long
No,
ago.
we stopped writing.
We stopped writing. Yeah, thank you. Sorry.
We didn't finish.
And the worst thing that happens, and I've only spent 4 years on the book, and the worst thing that happens is the moment you start talking with people, you realize, oh, wait a minute. You want to go change a chart or a paragraph, but it's at the printer. So we both laugh about, I'm keeping a list of the things we would like to change. There's some other stuff too. All right, wrap this all back up. That first column was the four questions. The second column was something we call variant perspective, variant perception. You use those interchangeable. And what you see is your different, you answered these questions. Your view is different from the consensus. That's that approach to the first question. You have to be different. This is your test. Second one, are you right? So to make money in the stock market, it's really simple. Be different than the crowd and be right. Pretty simple. However, there's other things. What's the market missing? We talked about, and the final piece is, how will the situation change? So that's your content. The first thing we talked about is stock selection. It's got to hit the investment criteria of the manager. The content, you have to answer these four questions. And now we have delivery. I think that's the next slide. Let's talk about this.
Oh, yeah, we didn't know there's a lot more to go.
There's a lot more to go. All right, this is the bad news slide. The bad news slide is there's, in all of this process, developing this variant perspective, different than the market. You only have three ways to get there. One is you know something the market doesn't know, which we refer to as an informational advantage. The second is that you've seen something that the market doesn't see. You've analyzed it differently. You realize there's more value than the market is giving it credit. And then the third is you have this trading or cost advantage. You can trade when others are unwilling to trade or can't trade. So that's it. Those are the only three edges you can get. Informational, I know something the market doesn't know. Analytical, I figured something out the market hasn't figured out, presumably yet. And the third is I can have access to a trade that the market has, that other investors either don't have access to or are unwilling to trade. We're going to run through this fairly quickly. All right, first one. It comes down to dissemination, observation of information. So if you either know something the market doesn't know, that's fundamental research. You've gone out and done a bunch of work. Market doesn't yet know. Great example that happened, was this in 15?
Yeah.
I think it was 15. Twitter put their first, one of their quarter announcements out on the tape early. It was basically an hour early.
On their website.
I'm sorry, on their website, an hour early. Somebody posted inappropriately an hour early. There are all these great softwares out there that crawl around and look for this. This one is Celerity, I guess how you pronounce it? Celerity. They, within 3 seconds, they found the announcement. Another, like, millisecond, they determined it was true and accurate, and they just tweeted it. They didn't care, the software didn't care that it's out an hour early. It would have been perfect, it would have been normal an hour late. Tweeted it out. The people that were very involved in the name, watching it closely, saw the tweet, realized that Twitter had missed. The numbers were below expectations. They had a pure informational advantage. Legal, by the way, because it wasn't as if you had the CFO call you or fax you or tweet you the information. It was tweeted out there, and people started to trade on it. And 20 minutes later, NASDAQ realized that there was a problem, they halted trading. But you can see that, I guess this was 07, yeah, 21, yeah, exactly 20 minutes later, there was trading based on that information. Stock, you see, started to trade down.
Yeah,
Halted
here's
the
the
trade.
volume. The volume spike.
Look at the volume, it's unbelievable. That was a pure informational advantage. You don't see those very often. You certainly don't see them in a way that you can really isolate them. They close it, they open up right before the close. You can see